everybody. We are back with another stock analysis, and I'm going to be honest, I have 45 minutes until my class starts, so we are going to be zooming through this video, which will be on Tractor Supply. I know absolutely nothing about this stock, so this will be a pure first look at the company. So Tractor Supply does kind of like animal food, outdoors equipment, really just like farm supplies, things like that. So it's a pretty big thing in the United States. I don't know about internationally, but yeah, let's get into it. Make sure to subscribe if you haven't, and let's look into Tractor Supply. So getting into Tractor Supply, business description here, they do a bunch of different things. Pet, small animal supplies, hardware, truck, towing, tool, heating, lawn, garden items, power equipment, things like that. So basically a lot of outdoors stuff, a lot of farm stuff. Looking at the industry metrics, this is essentially the complete opposite of what we saw from Estee Lauder yesterday. They have been having positive same-store sales growth every single quarter, and actually their stores have been increasingly positive. They have seen growth and further growth every single quarter. These are all estimates. Wow, I thought that was 2024. Still, they're estimating very large amounts of growth for 2025, which is awesome. I hope that happens. That would be excellent for the company. Expecting to see a lot of stores being opened over the next year, at least 100 or almost 100. So that is very good. Total amount of stores will be increasing a lot, and very few being closed as of right now, at least. So that's awesome. We'll see if they can actually deliver on that. But anyway, market cap is at 29 billion, 1.6% dividend yield. And we have a target price of $58 a share with a long-term growth rate of 8.5%. So right now we're at 54, so there is a little bit of an upside there. Looking at the chart, they've been basically in line with the market other than outperforming them a lot, actually, in 2020 as well as 2021. And since then, it's kind of been parallel to the market, outperforming slightly basically across the board. But so very good performance. They've been up a lot over the past few years. Their valuation basically tripled, which is awesome. But anyway, getting into their growth summary here, very positive. Again, very different from Estee Lauder, which is essentially the complete opposite, but it is still retail. Very solid 10-year long-term growth estimates. Cash flow is a little bit negative short-term, but that's not too important considering how positive everything else is. Also, this dividend growth is excellent, which, I mean, if you're looking for long-term income, 23% CAGR on a 10-year dividend growth is kind of really, really good. That's basically 23% more money in your pocket every single year. So looks very good there. Now let's start getting into the financials and see what we could see. So starting off with their sales, this is yearly. They're expecting record sales for fiscal year 2024, which is awesome. They've seen a lot of growth actually since COVID, which is a little surprising, just considering you would think that as a retail company, although I'm sure they do a lot of like direct shipment to consumers and things like that. So it makes a little bit of sense, but at the same time, they do have a ton of retail locations. So you would think they would have suffered, but actually since then, they've seen a very large amount of sales growth, which is awesome. Operating income has been very consistent as well, growing right alongside sales, other than 2024, where it's essentially in line, but a little bit lower. And then net income, same thing, very consistently growing as well. They may have lost a little bit of their profitability compared to what they used to have, but I'm not sure. We'll have to look at the ratios there. It's going to be close, but still having over, I believe this is in billions of dollars in sales. And yes, it is. So 14.8 billion in sales. So over $1 billion in net income for the past 3 years running is honestly really good. That their margins are very solid, especially for a retail company who usually has slightly less margins compared to some others. Total shares outstanding have been coming down rapidly. Now, I say rapidly, but realistically, it's about 10 million or so shares a year. But either way, that is excellent, especially for a company like this, where they're making $1 billion a year. Their market cap isn't insane at 29 billion. So they are taking tons of their shares out of circulation, which is awesome for the long-term value. And you could really see that here when you look at the growth of their stock chart. Their share repurchases had a massive effect on how much this has grown, because there are so much less in circulation that it is just massively growing. And honestly, despite how far up it seems like this is, I feel like they have a lot more room. I thought this was a larger company, and being at 29 billion seems like it's less than what I would expect. But anyway, moving on, basic shares look fantastic. That's all you really need to know there. Coming down so quickly, especially over the past few years. They've repurchased 20 million shares plus in the past 2 years. Even before the year before that, they repurchased about 17 million. So that's awesome to see. You really don't see that very often with companies repurchasing that aggressively. So that's really good. Looking at the balance sheet now, we have a couple things: 250 million in cash, which based on the way their debt situation is, that is not great. 5 billion in long term, 400 million in short term. So not very much cash at all here to be able to cover that. However, just to note, based on the way their growth has been going, I think this is completely fine. Their debt has been increasing fairly quickly, but overall, I don't think that's too big of a deal. I think they can very easily cover this should they need to. And that's about all I have for this. I would say they do have a little bit too much debt, but at the end of the day, based on the way their sales and earnings growth have been going, I think they're completely fine. And now let's head into cash flow. So operating cash flow has been also consistently growing. We did see a very good year there in 2020 where they had 1.4 billion, which they are at now, but a little bit higher. They're actually seeing their all-time high in operating cash flows in 2024, which is awesome. Now looking into this, a little bit of fixed asset sales in the past few years, which isn't really anything major. They did make some kind of large acquisition in 2022 for almost 400 million, which is almost always a very good thing, to be clear. Here is their stock repurchases. You could see they've essentially been putting 500 million or more for the past 4 years. And before that, they've still been putting hundreds of millions of dollars back into the company. This is billions of dollars worth of stock that's going back to the company, and it's out of circulation, reducing the supply so much that consumers will be able to push the price a lot higher. Or I should say investors will be able to push the price a lot higher because there's less shares on the market, which is awesome. A little bit of debt issuance over the past 3 years, 4 or 5 years, which we did see. I mean, their debt was increasing. That's expected. But nothing too crazy, just about 500 million here or there with another couple debts going up as well. But overall, I'm going to say that their debt situation is not a concern just based on how good their net income and income growth has been recently. Finally, free cash flow has been very consistent. 3-4 years of growth in their free cash flow so far. Again, very big year in 2020, probably because they probably cut costs so much or possibly reduced purchasing inventory to the point where they just had a ton more cash sitting around. That's what I'm going to assume happened there with it being such a high number, but overall, I'm not really sure. So we will move on. Now going to the ratios, the big thing here is, was their profitability decreasing as their sales were going up? So gross margin right now is right at slightly above the 5-year average, which is good. It looks like they've actually been very consistently increasing it. So looking at 32 10 years ago, 33 now. So nothing crazy. However, you have to remember that 32% 10 years ago was 32% of like 4 or 5 billion compared to 33% of, what was it, 14 billion in sales now. So much higher amounts of money returning to the company here, which is awesome. Operating margin is slightly below the 5-year average, but overall, I think just based on how much more money is being made now, I think that is still an okay number to have. Considering the year-over-year decrease is only about 0.3%, that's nothing too crazy. Same thing with net margin. There is a slight decrease, but again, I think that extra profitability or that decreased profitability is canceled out by their increased sales. So overall, nothing too bad here. And actually, if you look a few years back, even before COVID, their margins were lower than they are now. So seeing that they're above 7% now is pretty good. Also, ROA, ROE are both very, very positive. They are slightly below their 5-year averages, but overall, that positivity is very, very good. Very good to see. And one last thing, looking at their debt to equity. So, okay, this was something I was concerned about, was their debt to equity being so high. So I did say their debt wasn't an issue earlier just based on what I was seeing, but seeing this ratio, it honestly can be a problem. This is one of the higher debt to equity ratios we've seen. Their long-term debt to equity is at 221%. 5-year average is 195%, and their total debt to equity is at 238%. Those numbers are about 200% higher than a company with a healthy amount of debt, I should say. So overall, not great. I think it's okay for probably a couple years, but if this continues increasing, there's definitely going to be some kind of cash flow problems with the company because their debt situation is going to be crazy. Overall, I think it's manageable, but this really needs to start coming down. I think now, back down to that under 100% range. But that's also just my opinion. That's just kind of my rule of thumb with debt. It could be perfectly fine, but overall, I think seeing lower debt is much better. But anyway, moving past that, time to get into their metrics recap and see what we're dealing with here. So, not too much information here, unfortunately, but comps was slightly below estimates. Gross margin was also slightly below. Their SG&A was at 23.6% compared to the very slight estimate. It's slightly lower, which is a good thing. And a year ago, they were at 26.2%. So seeing that almost 3% decrease year over year is honestly really good. Depreciation amortization came in about $6 million above estimates, which honestly, I have no opinion over. That's nothing really major at all. Operating margin came in below, which is very bad. Not crazily below, but still, you want to see the company be more profitable. Obviously, no matter what. Inventories also increased faster than sales, which is generally a negative sign. That means that they spent a lot more money just on their own products and did not sell them as much as they invested into it, which isn't great. I would say. I don't really like so sales growth is good. Let's just get that out of the way now. But when it's outpaced by the growth of their inventories, that is not great. So they spent way more money on building their inventory and did not sell as much as they increased their inventories by. Let's go with that. So overall, I would say this is mostly negative. Saw some important misses, very slight beats. SG&A being down that much year over year is really good, but overall, I think it's a little bit concerning. We do have a fiscal year 2025 outlook here. Let's go into that. So first of all, this is, I believe, is just the exact same thing we saw. Returned more than $1 billion to shareholders through share repurchases and dividends. That's awesome. Other than that, we're going to keep going. So if you would like to read through these fiscal quarter and fiscal year results, please feel free to. I'm not going to read through everything. One thing I will say is they do highlight the 10.6 million shares repurchase, which is awesome. Returning 1.03 billion to shareholders. So that is fantastic. 80 new Tractor Supply stores and 11 new PetSense stores. So that's awesome. Other than that, fiscal year 2025 outlook, here we go. So net sales +5 to +7%. Comparable store sales is +1 to 3%. Operating margin rate is 9.6 to 10%. And actually, while we're doing this, let's compare it to what they're at now. So if we look, operating margin is right about in that range. So basically, they're just working on consistency there, which is always good. Net income 1.12 to 1.18. Let's see where we're at now. I believe we're also right in that as well, so nothing too crazy. Last net income is 1.101. So they're expecting a slight increase, which is good. Earnings per diluted share 210 to 222, which I believe we are actually they are expecting an increase on that, which is awesome. That'll definitely help with a lot of valuations with the company. Other than that, CapEx is at 650 to 725. Let's see what that looks like. Okay, so 780. So reducing that, hopefully, I believe that's what that was, 650 to 725. So reducing CapEx, that would be great for their cash flow. So I hope we can see that. And then share repurchases, 525 to 600 million. Again, that is phenomenal. Literally just directly returning equity and value to the investors. I love seeing that. So overall, I think this guidance is really good. I think there's a lot of promise here for the company moving forward. I love the way they reinvest in themselves through share repurchases. Again, just highlighting this, hundreds of millions of dollars a year are poured back into this company, as well as just dividends as well. So over $1 billion for the past 2, 3, possibly almost 4 years straight, they've returned over $1 billion for or to investors, which is awesome. Now that we're through that, let's see if we can get a valuation here. And I will pull that up as soon as I see it. But anyway, yeah, we will, as soon as it's up, I'll kind of get that going. And of course, as we like to see, there are no other company PEs available here. So let's see about home improvement. It might compare them to Home Depot and Lowe's here, possibly. And it is. Okay, so this is something that we can do. And I will get into that right now. So I pulled up my valuation spreadsheet right here. And now let's get into it. So first, I got to get rid of those from the last video and see 41.06 and 26.75. So let's get into that. 41.06 and 26.75, I believe is what that said. So let me just double check that. And yeah, okay. So based on their multiple different competitors, to be fair though to the company, this is in the home improvement subsector. So I can check out the other subsectors that they're in, but this is the one that comes up with the most other competitors with a lot of other data that we can go off of. And based on this, the current valuation is at $69 a share with a 25% upside, which is awesome. One thing to note that I will point out here is that there are two fairly large outliers here, a PE of 110 and 53, which is definitely dragging it upwards. However, if we just look at this though, their median PE is actually exactly the same as what Tractor Supply's is currently. So overall, I think it still holds up fairly well. So based on this, again, upside of 25%, let's see if there's anything else in building materials and garden supply stores that is a possibility. And it looks like it's going to be mostly the same companies. Either way, though, 44.01 and 28.29 will still make this, it'll actually increase it. 44.01. Let's just put that in, and then 28.29. And that gives a valuation of $73 a share with an upside of 34.33%. So overall, I would say pretty good compared to similar stores. There's also specialty stores. Let's see if anything pops up here. This might be a little bit more of a wide variety. And of course, there is no PE ratios available. So overall, I would say these two worked out fairly well, giving them a slight undervaluation, or I should say they overvalue the company compared to what it is now, which is awesome. Indicates a lot of potential upside, which is always good to see. So overall, I would say Tractor Supply looks really solid. The chart is up a lot over the past few years, but with what the valuation is right now, I feel like it's still not a crazy number. They did just have a split recently, actually, which is interesting. So their share price essentially used to be 5 times higher. So interesting company. I'd say a lot of potential upside, even despite all this growth. If we look at the past year, they've actually been fairly flat for most of the last year. So that could be support gathering, possibly. We do see higher lows forming throughout the year. So I think there could be a breakout soon, possibly. That is always kind of a fairly strong sign of an incoming breakout. So definitely something to pay attention to. Definitely a very high potential company, I would say. Even with like that huge dividend and a ton of dividend growth, I think there's still a lot of just pure stock price growth available here. It seems like a very solid company. So overall, that's all I have for Tractor Supply. Thanks so much for watching, everybody. Hope you enjoyed, hope you learned something, and I will see everybody in the next video.